he's coming here, building a concentrated portfolio of stocks based on, kind of his deep reading of the 10Ks and the fundamentals, et cetera. And he's arriving in a portfolio that, at least, today, seems very similar to what you might get if you did quantitative way. Munger told him to forget everything he knows, everything he learned from his hero, Ben Graham. And so there's a pretty market departure from your kind of old school, what Buffett has called cigar butt investing. 92% of his holdings were acquired above book value. And the thing is, it's not even just like a little bit above book value; it's a lot. Like the median holding, I think, had a price to book ratio of 3, and the average price to book near 8. About 90% of the 3 percentage points of alpha can be explained by factors, right? And of that, intangible value and quality are the 2 most important ones.
Hey, Kai, welcome back to Excess Returns.
Thanks for having me back.
Earlier this month, you put out a research piece titled Buffett's Intangible Moats, and in it, you dive into Buffett's investing style and how it's evolved over time, and how kind of you point out in the article that a lot of people kind of point to Buffett as a sort of a value investor, but that might be, actually off the mark, and you kind of explain why, and we're going to get into this through a bunch of charts and research that you put out. This was really an excellent piece. I think it probably took a lot of work, and I think our audience is going to see very quickly that there was a lot of man hours put into this puppy, but really appreciate you coming on. And you can go to sparklinecapital.com to follow Kai and get all of his research. So please support him and sign up for his stuff. It's really great. So let's start, Kai, by, I want to just, what was the inspiration here? Is this something you've been thinking about for a while? Like, what made you tackle this one?
Yeah, well, look, as anyone in the business can attest, Warren Buffett's always been, someone that, I as a value investor I've looked up to over the years. And, there are so many things about Buffett that are amazing. His longevity, the fact that he's evolved his process through multiple market cycles, his transparency, the way he, has outlined his principles so clearly in his annual letters and interviews, and his annual meeting, of course. But, I think the impetus in this case was the fact that he's retiring, right? So after 60 years of doing these 4-hour interviews at the annual meeting, he, at the very end of his session, announced that he's retiring, handing the reins over to Greg Abel, which is, of course, a tremendous loss for the industry, just because he's such an icon and such a, such someone that we look up to. But so the question became like, can I take this opportunity now to kind of distill 60 years of annual letters and writings, look through his positions, historically his track record, and try to kind of generalize and distill the principles that have made him successful over time, with an eye on this idea of evolution, right? Like, nobody's static. The markets are always changing. The economy is always progressing. To what extent is the Buffett today different from the Buffett of 1950 when he was a student of Ben Graham, the father of value investing? And so that was kind of the quest. I spent, a few days in the, so shout out to the New York Public Library, which had excellent archival resources, just going through all the kind of historical positions and financials of the different companies he's held over the years. And, just kind of like that, that experience of just kind of going back in time and, going back to the days of early Berkshire, and then, through the 90s, 2000s, and then up to today. It's just so fascinating to see how he's changed his process and, trying to generalize what are the main principles underpinning that evolution.
Yeah, I find it very interesting, like that, this first chart we're going to show, which you have in each decade. So starting in 1980, what the top holdings were, in 1990, what the top holdings were, 2000, 2010, and 2020. So, when we're looking at this, sort of, what does this show you in terms of Buffett's evolution? What do most investors sort of get wrong about Buffett's investing style? I think if you asked probably many professional investors, like, who's the best value investor, Warren Buffett's name probably would be at the top of the list. But, I think, as this points out, it's not, he's not a deep value guy, or he's evolved, I guess, over time.
Yeah, I think if you look at this chart here, you can kind of broadly see 3 key epochs. So the first stage was kind of the blue and the red. So this is when his largest stocks were Geico and Washington Post, right? So over this period, again, this was when he was, just kind of, had just wound down his partnership and was starting, had acquired Berkshire and was kind of building that out. Berkshire, of course, being a struggling textile mill in New England. And was building out kind of the beginning of this what ultimately would become the, trillion-dollar company that it currently is. And, he was only, 10, 20 years removed from being a employee at Graham Newman, where he was, where basically Ben Graham was his boss. And before that, when he studied at Columbia Business School under Ben Graham himself, right? And so if you read Security Analysis, Graham's, tome, The Bible of Value Investing, which came out in 1934 during the, right after the Great Depression, it was all about buying these kind of undervalued stocks that were trading below net liquidation value, below, tangible book value, which, at the time, industrial age, was synonymous with, intrinsic value. So the idea was, if you open up Security Analysis, my first job out of college at GMO, I got this book placed on my desk and was told to read it. And, if you go through it, all the examples are, textile mills and public utilities, railroads, right? So this was kind of the starting point of Buffett's, career in investing. And that, largely mirrored what happened here. He owned Geico. I think he bought it at a price to book ratio of 0.44, right? So deep discount, even just to its asset value. He bought other companies in the insurance sector. I mentioned a couple of newspapers, materials firms, retailers, and advertising were kind of the core of his portfolio at the time. You then kind of go to stage two of the process. This was starting around like late 80s, early 90s. He started investing in consumer stocks, most notably Coca-Cola, which became his largest holding for 20, almost 30 years. He, is a huge fan of Coca-Cola, of course. He talks a lot about See's Candy as well, Gillette, Procter & Gamble, Anheuser-Busch, Guinness. So all these consumer stocks. And then within the financial sector, kind of branching out beyond, more kind of traditional insurance names to guys like, Amex, American Express, or Moody's, the credit rating agency, which, rely more on network effects than kind of the traditional investing businesses. And then you fast forward again to the 2010s and until today, and that was kind of the third stage of Buffett's evolution, where he bought, Apple, of course, being the most famous thing. He moved into technology stocks. Apple, he bought in 2016, ended up becoming half his portfolio at its peak, and made Berkshire $120 billion just on that one investment alone. So it ended up being kind of a huge win, kind of the capstone of Buffett's career in many ways. And so you kind of have these three divisions of, three eras of Buffett's career, which you can kind of like intuit and just kind of build up this idea just from bottoms up by looking at his oppositions through time.
I love that historical perspective. I always find that like very interesting to think about, and you kind of captured it great in that chart. So and you kind of hit on this, but you can kind of chunk these out. We can kind of get a little bit more micro with it and chunk these out with specific companies. And you sort of framed it up in the article where you sort of used Geico, Coca-Cola, and then Apple, and sort of showed this evolution going from like industrial to consumer to like information and tech. So just kind of work through like those three examples.
Yeah. So I think, so the way I framed it in the paper was that there are kind of the three ages of, Warren Buffett's career. And this goes back to the point I was making that, a lot of his success has been, due to the fact that he's managed to evolve. He's 94 years old, but, he's kind of a old dog with new tricks, I guess. And I mentioned the three different stages, which are kind of symbolized by those three major investments, which also, by the way, map to kind of the evolution of the economy as Buffett himself was, working in the industry. So like I mentioned in the 50s to 70s, that was your kind of industrial age when, a lot of the teachings of Ben Graham still applied. Book value was still synonymous with intrinsic value, and Buffett's largest position was Geico, an insurance name, right? Which obviously relies heavily on tangible capital. And then you had your consumer age, and this was when you had the rise of these consumer brands. Coca-Cola being, of course, the greatest example, and also coincided, by the way, with the influence of Charlie Munger in the 70s, who became vice chairman of Berkshire, and kind of helped convince Buffett to adapt his philosophy. I think the quote that Buffett mentions in his letter is that Munger told him to forget everything he knows, everything he learned from his hero, Ben Graham. And so there's a pretty marked departure from your kind of old school, what Buffett has called cigar butt investing. Buy these kind of deep value stocks. These are mediocre companies selling at wonderful prices, and kind of take one last puff and then move on. The philosophy evolved to being now, of course, wonderful companies at fair prices. And these are companies that earn, high returns on capital, and and do this, by the way, because of the presence of intangible assets. So this is a really important point. I think, actually, Justin, you highlighted this quote, which I think is really good. So I'll just read the entire thing. So this is from Buffett's letter investor letter in 1983. He says, "My own thinking has changed drastically from 35 years ago when I was taught to favor tangible assets and to shun businesses whose value depended largely upon economic goodwill. Ultimately, business experience, direct and vicarious, produced my present strong preference for businesses that possess large amounts of enduring goodwill and that utilize a minimum of tangible assets." So what he's really saying here. So what is economic goodwill? I mean, Buffett had he devotes a whole appendix in this letter. It's pretty long to this idea of economic goodwill, which is basically intangible assets. And what he says is, look, a company like See's Candy, this is the example he chooses to use in his appendix, earns returns on capital that are far in excess of what you could expect based on its tangible capital alone. How are they able to do this? Well, if you capitalize this excess return, he calls that economic goodwill, intangible assets. He says, in the case of See's, it's consumer franchises. In the case of the television networks, which he owns, it's the kind of regulatory moat these firms have. And so the idea is, look, like when he first started out, and this is 35 years before 83, right, with Ben Graham, he was taught, go for businesses that have a lot of tangible assets and stay away from those kind of like sketchy, weird businesses that are all dependent on intangible assets. They seem like they're unreliable. You fast forward to 83 when he says, look, I'm now doing the complete opposite thing, where what I'm doing is I'm buying companies whose values primarily ascribed to their intangible assets, and I'm trying to stay away from kind of too asset-heavy businesses. And so this is a pretty big mark, pretty big shift. A lot of the discussion in this letter and others is around brand equity. That's kind of the big thing that Buffett realizes is really important, and of course maps to his emphasis on consumer brands over this period. And then the final shift happens in, the mid 2010s when he buys IBM, then Apple, and he kind of moves into the technology space. And this is when he's adding this is of course when the information age, which of course was nascent in these 90s and 2000s, but really took off. Obviously it wasn't until more recently that you can't really live your life without an iPhone and without the internet. This is what the type of period we're talking about now, where it's intellectual properties, network effects that drive value. And Buffett, of course, talks a lot about the asset-light economy, and it talks about how it is the case that the largest companies, the NVIDIAs, Apples, Microsofts, don't require any net tangible assets to produce earnings, right? It's, we're long past the days of, Geico, Exxon, GE, where those tangible assets matter. We're now in the modern day, where 80%, let's call it, of value is now intangible. And so that kind of those kind of three phases, I think, map nicely to the biggest holdings that he maintained over the period, the kind of influence he's had from outside mentors like Munger, and finally maps to the kind of evolution of the economy through time from industrial to consumer to information based.
It was eye-opening to me how early this quote came from. Like, this was from the 80s. I mean, this could be a Kai Wu quote, I think. Like, he realized very early the importance of this stuff.
Well, yeah, he's way ahead of me. I can tell you that.
So I want to talk about Buffett and intangible moats, but first I think I want to just go back to your work and talk about the different types of intangible moats, because this is something you've covered in other papers. So can you just talk at a high level about the different types of intangible moats that exist?
Yeah. So the idea here, by the way, was to develop a quantitative way of assessing intangible value. Right. And so that's the key thing. Obviously, Buffett recognized as early as the 80s that that most of the value of the companies he owns was in the intangibles. My goal here was to say, can we kind of come up with a quantitative way of building scores for each stock, in the investable universe, with regards to their overall intangible value, but then also their kind of like the different components of value. So first of all, what are the four components of intangible value? There are four of them. The first one is brand equity, then human capital, intellectual property, and then network effects. And so these things, there may be other kind of ways of categorizing it, but broadly speaking, these four pillars comprise the vast majority of intangible assets, and most intangible assets can be kind of shuttle into one of these four categories. So how do we calculate it? Well, the idea is we just kind of go bottoms up. We look at, a variety of data sources, both structured, like accounting information, and also unstructured. So for example, for IP, we'll look at the patents, and we'll use natural language processing tools like large language models and what's now called AI to read all the patents and kind of assign values to them, and then say, hey, which of these companies have the most patents, most innovative patents per dollar invested? You do the same across brands, say using trademarks and social media, Glassdoor reviews, LinkedIn profiles for human capital. So you have these scores now for all the different pillars. You can then average them at the pillar level to have a composite score for brand, for IP, etc. And you roll them up into a final top level tier for composite intangible value. Right? So that's how the scores are created.
And this exhibit 5 in the paper is really cool because it actually shows, from the perspective of what you just talked about, it shows his evolution over time. So going back to the same companies we talked about before, Geico, Coca-Cola, and Apple, this shows the breakdown of their balance sheet over time.
Right. So that was the idea, which is, look, I think so far what we've seen is more anecdotal. It's like from a narrative standpoint, we do know that Buffett has evolved from being like your traditional Graham and Dodd book value investor to something that's different, that's more intangible oriented. But like I wanted to be able to quantify this like in a more systematic way. And that was the idea of this exhibit here, where now I'm saying, let's use my scores, which are developed independently. So they just take them as exogenous and now say, let's use this lens that I've developed to decompose the balance sheet of these 3 iconic investments that Buffett has made. And you look at Geico, right? This is taken in 1978. So this is Geico kind of in real time. And it's 75% tangible. So they have, a strong brand, good management, et cetera, but it's still an insurance company, right? Most of its value is going to be intangible capital. Then the middle example in the second age is Coca-Cola, 1989, right? In this case, tangible capital is only, 10% of its overall values. The other 90% is in these intangible assets, of which by far brand equity is the most important, followed by some human capital. And then you go to 2012 in this case with Apple, again, the tangible capital is pretty insignificant as a function of the overall, whereas the intangible assets are, 95% of the total, and it's kind of diversified across them. But if you squint, you'll see that intellectual property and network effects are kind of the 2 most important of the 4 in this case. Right? And so that does illustrate not only the transition of Buffett from being kind of tangible capital as the kind of the be all and end all to intangible assets matter more. But it also shows the kind of within the intangible pillars, how, at first it was, all about brand and some human capital, and then later became intellectual property and network effects.
Do you think sometimes he doesn't get enough credit for changing? I mean, obviously Buffett has changed over time, but people talk about that circle of competence thing, which you referenced later in the paper, and they kind of always criticize him. He didn't get into tech quick enough. But if you look at something like this, I mean, he definitely did evolve over time. So you think maybe he doesn't get enough credit for changing his style?
Yeah, no, I think people, people still associate Buffett with kind of the Ben Graham old school value investing. I don't think they give him enough, credit for evolving. And here's the other thing to remember: he's running a huge company, right? Many of his holdings are private companies. He's a $1 trillion market cap today, and so it's very difficult to evolve things over time. Like, you can't just like change on a dime. And so you have to also keep in mind that oftentimes where Buffett is intellectually, may not yet be reflected in the portfolio. That takes many, many years for him to kind of reorient this ship that's become this juggernaut that is now Berkshire, into the positions. So I think the positions will kind of reflect with a lag his intellectual thinking.
And as this Exhibit 6 perfectly illustrates this idea, because this is now taking it, we were looking at individual companies before, now we're rolling it up to the entire balance sheet, and we're looking at how he's evolved over time.
Yeah, so this shows the same exact picture, but more in a more rigorous way. Where we're now saying take his entire stock portfolio and kind of decompose it along these 5 pillars, I guess. And what you find is in 1978, when the sample starts, it's 70% tangible, 30% intangible. By the end, tangible capital is at 25% of Berkshire. So the other 75% is in these intangible assets, of which brand equity takes center stage first, followed by human capital, followed by intellectual property, and finally network effects. And so that kind of mirrors that story I just told around the 3 stages of Buffett's evolution.
I'm just curious, Kai, the historical data, where did you get that from? The historical.
So a lot of annual reports. I mean, the good thing is that Buffett's portfolio is pretty concentrated. So he's not holding like 1,000 stocks. He holds, a handful of stocks that matter. So you can just go through them. I went to the New York Public Library and like sat there for a long time. And you kind of just pull out the annual archives of companies like Geico, et cetera. Going back through time and then kind of hand entered it, right? Like pulling in like the stock prices and the book values and these various things.
Cool. It's kind of cool to know too that even in the world of AI, we still have to occasionally go to the New York Public Library. I don't know if my kids, I have kids, I don't know if they'll ever step foot in a library. I hope so, but it might not ever happen.
I mean, somebody would be doing the world a great service if they went there and just digitized a lot of this data. right? Because like right now it's, the Thomson Reuters, the S&Ps, the Bloombergs have a kind of a monopoly because they've in many ways like, been the first to do that. But, I don't think there's any reason why you can't do it. It's publicly available information, right? It's generally SEC, mandated public data. So someone should go in there and do it and make it a open source project for everyone. That would be pretty cool.
I'm sure it's coming. At some point, it's going to come.
Yeah, I mean, it would be pretty. It's definitely faster now with AI for sure. I did this all by hand because it wasn't like a huge amount of work. But yeah, I mean, if you wanted to scale across thousands of stocks, that would be the only way to do it efficiently.
Going back to this idea of Buffett as a value investor, you had a really interesting stat in the paper, which I believe only 8% of Buffett's holdings over the period you looked at were bought below book value, which I think a lot of people would be shocked. Like I was shocked, and I know a decent amount about Buffett, that he is not really the deep value investor that many people look at him as.
Yeah, I mean, this was kind of the crazy stat. I mean, I almost made this the first sentence of the paper because I was like so impressed by that. I was like, that's such a kind of narrative violation, right? He's a deep value investor. Like he was trained by Ben Graham, and wait, only 8% of his stocks were ever bought below book value. That's wild. Now, keep in mind, of course, that Berkshire, the data goes back to 1978, which was when he first started writing his letters, and Berkshire wasn't really a thing until a few years before that. That being said, like, and so if you go back to the 50s, let's call it, right, Buffett was certainly buying these deep value stocks. But at least over this period, that is kind of the more modern Berkshire. It is the fact. It's just factually true that only 8% of the holdings were acquired below or held even below book value. And by the way, most of those examples occurred in like the late 70s. So that was a kind of, during that inflationary spike when we were in a pretty deep bear market at the time. Right. And then, so that was most of the observations. Since then, it's been even less frequent that he's kind of gone out there and bought a stock below book value. And what is the opposite of that? The opposite that means 92% of his holdings were acquired above book value. And the thing is, it's not even just like a little bit above book value; it's a lot. Like the median holding, I think, had a price to book ratio of 3, and the average price to book near 8. Right. So what does the price to book of 8 mean? It basically means that almost 90% of the value of these companies is not captured by the tangible value, which is wild, right? 12% is tangible, the other 88 or whatever is intangible or other. And I think that just kind of like speaks to where Buffett ended up, right? Like he, started off kind of, working for Ben Graham and by the end of the period or even midway through, I guess as we've seen, his style of investing would be totally unrecognizable to his mentors.
Yeah, I would guess even if you surveyed people who are like students of Buffett and you said, what is the average price to book of one of his positions over time? I don't think anybody's coming up with 8. I mean, other than the people who really studied him, maybe Adam Mead or someone, but like, I think that would be shocking to even like Buffett followers.
Well, the other interesting stat, right, was when I first saw that, I was like, all right, maybe he's just, maybe it's just the market's becoming more expensive, right? The late 70s where the market was pretty cheap. And then, obviously, and this is something that's happening economy wide. It's not just about Buffett, but like the economy is becoming more intangible. Intangible assets are becoming more important. Book value is explaining less and less of the market cap of stocks. That's just a well-known thing. So maybe it's not about Buffett. Maybe it's just about the way the world has evolved. What's really interesting is that you can actually look at the not just the absolute, but the relative. So you can look at the price to book of Buffett's portfolio relative to that of the average S&P 500 stock. And what you find is that in 85% of years since the same period, Buffett has actually had a price to book higher than that of the market. So his portfolio has traded at a premium to the S&P 500 equal weighted stock, which is kind of interesting too, right? So it's not just about him, refusing to reduce his margin of safety in an absolute sense. It's also in a relative sense. He's tending to prefer companies trading at a bit of a premium to the market. Right? Like Apple trades at a price to book of like 50 something, right? Which means that 98% of his value is not tangible. So of course, just the fact that he's willing to buy stocks like that, implies or just means that he must view tangible capital just not the only piece of value for a company, and by the way, probably the minority of the value for most companies.
And we're going to talk about return attribution later, but what also struck me just looking at this chart is some of his best performers also are on that high price to book side of the equation here.
Yeah. I mean, he held Coca-Cola. So he bought Coca-Cola at a price to book of 4, okay, in like the late 80s. And he held it through the 90s, even as its price to book ratio went to 23, right? Like, and again, I mentioned he bought Apple at a price to book around 4 as well in 2016. And he holds it now with a price to book over 50, right? So like, I think a lot of it, I think that just really illustrates that, he doesn't see tangible book value as the only source of intrinsic value. Well, that may have made sense in the 30s, 40s, and 50s. It's just not the way the world works today. And Buffett recognizes that. He's recognized that as early as the 80s, he saw that.
So we're going to talk about how the intangible value of his portfolio has evolved over time. But first, I want to just let you define it. I mean, it gets back to some of the stuff we talked about earlier, but how do you define like an intangible value score?
Yeah, so intangible value is just the idea of, so what is traditional value? Traditional value is looking for stocks that are trading below intrinsic value. And in general, intrinsic value is, some kind of measure of tangible capital, right? If you kind of think of a strict Graham dot approach. In my case, I'm just saying, look, intrinsic value is equal to tangible capital plus intangible capital. And so let's just expand the definition of intrinsic value to a more holistic measure that includes these 4 pillars, and then look for stocks that are cheap relative to that more holistic measure. That's all the score is. I think I told you already kind of how we define it based on the underlying metrics. And the only thing I would mention in addition to that is, so we have all these different metrics. We kind of, like the patents, the PhDs, the employees, like all those different metrics, and we'll average them at the pillar level. So we have like 4 kind of sub pillars. So what's the overall intangible value score for brand, for IP? And then we add that up to create a single score, composite score for the entire stock. And we do this across all stocks, and then we normalize, which importantly means that the score for each stock is relative to all their stocks at that point in time in the investable universe, right? So a score of 0 means you're average, and a score that's positive means you're above average, and a score negative means you're below average. So that's just how we're defining it for the purpose of this paper.
This would be something similar to what those of us who run value strategies think of as a value composite. You're just doing it across different metrics than we would use.
Exactly. It's a value composite where, a lot of the underlying components of the composite are intangible. The denominator, so to speak, is intangible as opposed to tangible. Like looking at like R&D or patents. And so instead of saying what is the dividend yield or the earnings yield, it's what is the patent yield? What is the PhD yield?
So as we go to Exhibit 10, we've talked about how Warren Buffett might not be the value investor people think he is, but as we get to Exhibit 10, as you adjust for this stuff, he becomes a value investor again.
Right. It's just a different definition of value. It's intangible value. So like if you look at this, at this exhibit, basically from 78 to 1990, the score is averaging around 0, which is just to say that, he neither has a preference nor dispreference for intangible value. It's just something he doesn't really notice. He doesn't really his stocks are pretty average, right? His portfolio is pretty average on this factor. But then starting in 1990 and then kind of moving forward through time, it starts to kind of gradually increase until you reach around 3 today. And a score of 3, by the way, just if you look at the overall universe, maps to the top quintiles. So roughly his portfolio is like the top 20% on intangible value, right? So this has become a more and more important driver of his stock selection process, right? Again, implicit, like he's a discretionary investor, he's buying things bottoms up, but if you kind of back into what he actually ends up buying, it's more and more kind of converging to a quantitative view of, hey, it's just, companies with a lot of, good IP and good human capital is defined by these scores relative to their price.
Do we know how much of this is like the people that are working with him now? As obviously as he leaves the firm, I assume some of the new people he's brought in, who are starting to run the portfolio now, probably focus on this intangible stuff, maybe more than he does. Is that right?
Yeah, I don't know to what extent it's explicit that he has intangible analysts and not. I think it may be more sector focused. I know with Apple, right? It was his 2 lieutenants, Combs and Wexler, who kind of initially found and kind of pushed him on the position. But obviously at the end of the day, the decision to scale up from a sleeve to be half his stock portfolio was his, right? So and I think there's some kind of funny stories of him, Tim Cook himself, giving Buffett a tutorial on how to use the iPhone because he's not really tech literate. So it goes down to the circle of competence, right? Buffett has always said this, and Munger as well. I think there's a quote that Munger gave that I have in my paper in 1995, where he talks about how it's not that they hate technology, it's just that that's not their skill. We just don't know anything about technology, it's not our edge. So we want to stay within our circle of competence. But of course, over time, and then we talk about this in the paper as well, the world changes. And while tech may have been a niche thing back in the day, it's the entire market, right? So you kind of can't ignore the entire market. And I think that's going to force Buffett, maybe with the help of some of his key personnel in that direction, right? So Buffett's again, he's an open-minded person, right? He started off, Ben Graham was his idol and he studied under him, but he has credited Munger over and over again with being kind of the architect of Berkshire. The modern Berkshire's blueprint is thanks not to Ben Graham, but to Munger. And, and I would assume that, a lot of the people he has kind of working with him now also play important roles in kind of the running of the portfolios. Exactly how much I don't know. But, almost certainly has played an influence on kind of his current thinking.
That balance of circle of competence is so interesting to me because in one way it's good. Actually, we talked about it being maybe bad in the past, but it's like, it's good that he only invests in stuff that he knows. But then that balance of like, when do I expand what I know? So, for instance, like Buffett probably shouldn't be buying like Solana right now or something like that. That's probably too far outside, but you could argue like just how to expand that and how quickly to expand that is a very interesting, I think, balance for all of us as investors. Like, what do I know? But also how do I expand what do I know?
Yeah. I mean, it's a delicate balance. If you have, a really, really wide opportunity set and you say, I'm going to just go for everything, like, yeah, I mean, you're going to get a lot of at bats, but like, if you don't have any edge, right? Because you're diluted your edge so much, it's not going to be a great outcome. On the other hand, if you said, look, I have this like one really, very specific niche, I just do this one thing. I only buy Solana, right? Or I don't. All right. Well, like basically sometimes Solana will be cheap, sometimes it'll be expensive, but like when it's expensive, you just sit in cash, right? So basically if you want to demand a margin of safety and you have a narrow opportunity set, you're not going to be doing much for much of the time. And Buffett's now Berkshire's $1 trillion company. They can't put all that money into, well, definitely not Solana, but most things, right? So as you get bigger, if you don't adjust your opportunity set, you don't adjust your circle of competence to be wider, you're just basically forced into a more narrow box, which will either result in you compromising your margin of safety, or it'll result in you, deciding to widen your circle of competence, which it seems like Berkshire has kind of headed in that direction, but, arguably not fast.
So as we look at Exhibit 11, we're looking at the current portfolio now in terms of intangible value score. What do you think are the biggest takeaways from this?
Okay, so these are the top 10 stocks. The biggest one is Apple at 21%, then Amex at 16%, Bank of America and Coke both at 10%, and so on and so forth. Well, first of all, these 10 stocks comprise 80% of his stock portfolio. So he's a very concentrated investor. Okay. The second thing I think is if you look at the right column, you see the intangible value scores. These are based on my metrics of these 10 companies. And what's really interesting is that 9 out of these 10 companies have a positive score, and generally a pretty positive score, above 0. Only one, Moody's, has a negative, right? And if you average across the entire portfolio, you get a score of, I think, 2.6, which is roughly the top 20%, kind of what I was saying before. So what's interesting, right, is that, Buffett's a discretionary investor. He's coming here, building a concentrated portfolio of stocks based on, kind of his deep reading of the 10Ks and the fundamentals, et cetera. And he's arriving in a portfolio that, at least today, seems very similar to what you might get if you did the quantitative way. Now, the quantitative portfolio would have, more names, right, and be more diversified, right? So this is kind of your classic circle of competence thing. Quants tend to be, more diversified across more names, with a smaller edge on each one, whereas like discretionary investors tend to be more concentrated in fewer number of stocks, more edge on each stock, but with a more narrow opportunity set, they don't get as much breadth there. But the point being that like the average result is about the same. Like they're both the quant and the fundamental approach, Buffett's approach, would have yield portfolios that are kind of selecting for the single type of score, which is intangible value. The second thing that's interesting is the primary pillar. So what I do here is a company like Apple, as I showed you, has 5 different pillars, right? It's kind of a diversified basket of different underlying assets. But, if you had to choose one, IP, intellectual property, is the biggest one. And so we do that for each stock. We say, what's the primary thing? Like for Amex, it's brand, for Coca-Cola, it's brand, for Moody's, it's network effects. And if you do that at the portfolio level, you find that, tangible capital is only about 25% of his book. And the intangible capital is 75%, of which brand is the most important component. So even though we're, far away from the 1990s when it was kind of the main driver of his book, it still remains the biggest thing. And Apple kind of on its own is like the only kind of IP driven firm. Most of the companies aside from Apple, that's just kind of a singular exception maybe, are kind of more in your brand, human capital, tangible capital categories.
So we're going to look at factor attribution of the history of Berkshire's returns. But before we do that, I want to ask you a high level question about this, because this is something AQR did a paper called Superstar Investors where they looked at this too, and they dealt with this issue. What people will say a lot of the time is when we break down Buffett's returns with factors and we look historically, people will say, well, what was he really doing? Like he shouldn't have even been, he was wasting his time. He basically could have just used these factors. But one of the things they pointed out in the paper is we know these things now. We didn't know these things then. this may not take away from what Buffett did just because we can break it down with factors now. So how do you think about that before we get into the analysis?
Yeah. So first of all, like that AQR paper, I think it's called Buffett's Alpha, was kind of an inspiration for this section, so this part of the analysis. And what they did was they took Buffett's historical returns and they said, let's use a multi-factor regression. And this is what I do too, on a factor model to say, hey, take the returns of say 6 different factors, and then the dependent variable is the returns of Buffett's stock portfolio, and then attempt to kind of figure out what are the loadings on each one. And doing so, you can kind of like reverse engineer what are the factors driving his historical returns, right? And as you point out, like a cynic might say, oh, well, Buffett was just doing like these sorts of factor and this factor approach, like what's special about that? And I would say that that's kind of missing the point, right? Like a lot of these factor models weren't even really invented until like the 90s, 2000s, 2010s. Certainly were not considered widespread. Like I would say that some of the factor of like, traditional value, the Fama French models came out in the mid 90s. So like you could argue that maybe those are kind of more popular by the 2000s or whatever. Like AQR itself is of course like a pioneer in practitioner, quant practitioners using, kind of smart beta or factor analysis in investment products. I would argue that intangible value as a factor still is, pretty underutilized, relative to some of the other ones. So the point just being that, Buffett's pretty impressive because he basically like backed into these ideas well before they were kind of mainstream in the industry, just through trial and error. He's sitting there, with his two hands, like picking stocks, one by one, and he kind of organically gets to the point where he, is owning these factors, right? Like he almost like invented this stuff on his own without any help from the academics. And by the way, he was doing it at a huge scale, right? Keep in mind that like a lot of these academics are like, oh yeah, we're just like ignore transaction costs in our tests, like whatever, right? Like Buffett's like, no, he actually is buying these stocks and he's putting billions, if not tens of billions of dollars of work at work buying these actual companies. So he has a live track record doing basically factor investing, whether he probably wouldn't call it that, but let's call it factor investing in the, 80s, 90s, 2000s, 2010s, well before, the AQRs and, I used to work for GMO, not to pick on AQR. These types of firms, really started doing it. So I think, you got to give the man credit for what he's done there. And conversely, right, any analysis that we're doing, whether by AQR or by us, it has the benefit of hindsight. Like we're kind of ex post going in there and reverse engineering this process. Are we making the claim that we in, the 80s could have defined these factors and then use it to decompose these returns? No, not at all, right? Like not at all. This is useful for two reasons. First, just as a way of explaining the historical returns, kind of understanding, with the benefit of hindsight, why did they outperform? Like, you're looking at a sports game, why did the Patriots win this year? Oh, it's because they did these things. Like they're only really knowable with hindsight. And second, I would say that the goal here is really more kind of moving forward through time. I would argue that this factor model, which we'll get into, is kind of a pretty good explanation of his returns, of his process. And so if your only goal is not to say to, recreate history, but instead to kind of figure out what will work best moving forward to replicate his returns, I think that for that more limited objective, this model, could work pretty well.
What did you find when you looked at the factors that have driven his historical returns?
Yeah. So first of all, what are the 6 factors of the model? That's the important thing to start with. The first one was a market factor. So just like, does he have, is he long only or not? Second one is small cap. Does he like small caps or large caps? The third factor is momentum. Does he tend to buy stocks with high trailing returns or negative trailing returns? Third is quality. Are you buying stocks with high trailing profitability or low trailing profitability? And then the final one is and then the next one is traditional value, which is just like price to book, defined kind of the Fama French way. And then the final one is intangible value, which is the score, I just described. So you have these 6 different factors. And I did a couple of different analyses. So first I looked at the entire time period. Then I looked at a sub period of the more recent years. Then I did a sector control where I said, let's control for the sector exposures. And, across the different specifications, what I found was that there are only really 2 factors put aside the market that were, consistently positive contributors to, in terms of his returns, but also in terms of his exposures. And those were quality and intangible value. And so again, quality is defined as a long portfolio of stocks with high trailing profitability, so high ROE, and short one with low trailing ROE. and then intangible values, a portfolio that's going long stocks with the highest intangible value, and then short those with the lowest. And what we find based on the regression is that his returns correlate most when adjusting for everything else with those two factors.
Just one more for me before I hand it over to Justin. I just want to ask you about leverage, because that's something that AQR, they identified what it was: value, quality, and leverage as the three factors I think that primarily drove his return. I was interested, when you introduced intangible value in here, did it take leverage out of the equation? So in other words, did you not need leverage to explain the returns once intangible value was put in here? I believe they attributed like 1.7 leverage in history as a big driver's return in addition to the factor returns.
Yeah. So what that 1.7 is important for is to bridge from the returns of Buffett's 13F stock portfolio to his overall portfolio. So when this entire analysis, as you may have noticed, I focused only on the publicly traded stocks that Buffett holds, right? And of course, Berkshire has a few things. So Berkshire, as the stock BRK or BRKAB, represents a company that has like three pieces. Okay, so the first piece is its public stock portfolio. Second one is its private stock portfolio, private equity portfolio. So that's like BNSF, that's Berkshire Energy, Geico's in there now. It was taken private in the 90s. And then the third piece is leverage. And what that means is that Buffett runs, as you said, 1.7 times leverage on average. So you think about it this way, which is if I was, owning the stock portfolio in my Interactive Brokers account, I would have a 1.7 times multiplier on that, right? And how is he doing? Well, it's a combination of different things, and there's a lot of advantages he has. He uses some derivatives, various, borrowings and stuff. But the most interesting component of his leverage is this thing called insurance float. So the idea is if you're an insurance company, you get the premiums from your members up front, and then you pay them back once something happens in the back end, like a fire or a car accident or whatever, right? And there's a gap between those two things. So over that period, you're effectively getting float. You're getting leverage from your customers. And it turns out that based on, the success of Buffett's and Berkshire's underwriting is that they're actually able to obtain this insurance float at an interest rate that's below that of like the, risk-free rate. So in other words, they're getting kind of like getting like cheap money, cheap borrowing, below what you get even if you're the government, which is, pretty cool. So that's a kind of key source of their advantage. If you look at the returns of Berkshire stock versus the Berkshire stock portfolio, Berkshire stock has outperformed its portfolio by about 1.7 times. Again, that's fully explained by this leverage. If you were to lever up his stock portfolio 1.7, you'd actually be slightly ahead of his overall portfolio. And I think the other thing worth mentioning is the third component, the private equities. Maybe it's the case you might think, there's a liquidity risk premium. So maybe actually the reason why Buffett's done so well is not because of the leverage, but because the private stocks have done so well. Well, actually, that's not the case. It's the opposite. In fact, the public stocks that Buffett has owned have actually outperformed historically the private equities that he has. Now, the private equities are important for other reasons, one of which some taxes, etc. One of which is, of course, the ability to obtain this insurance float, which can then benefit the overall business model.
So just because you were looking at the public portfolio here, the leverage is not a factor.
Exactly. So that leverage is really only important to bridge, to explain the gap between the actual returns of Berkshire stock and the public stock portfolio.
Let's go back to just the factor attribution for a minute. So you have Exhibit 17, which shows what amount each factor contributed to the total return, and then sort of the alpha portion of it. So I'll let you sort of explain that here.
Yeah. So once you kind of determine what the factor exposures are, for what you can do next, you can actually do distribution, where you can say, of the total returns that Buffett had generated in excess of the market, which ended up being 3 percentage points per year, what percentage of that can be attributed to the various factors, and then what is unexplained. So what's his quote unquote alpha, right? And what we find is, to the point that you guys kind of started the session off with, is that, about 90% of the 3 percentage points of alpha can be explained by factors, right? And of that, intangible value and quality are the two most important ones. They each explain about 1.1 percentage points of excess return per year, followed by traditional value at 70 basis points. Momentum was a little bit negative, and small was insignificant. And then, so that means that 2.6% of the 3% is explained by his factor exposures, leaving 40 basis points to be his unexplained alpha. And so this is just kind of making the point you made earlier, which is that, at least with the benefit of hindsight, it turns out that, there's a state of the world where, Buffett's this like magical person with this crystal ball, and he just kind of like picks amazing stocks, and, regardless of the sector, the style, like the industry, whatever, he just buys the best stocks no matter what. In which case, with him retiring, you'd be really concerned that this process is basically going to go away. But, fortunately, that's not the case. Fortunately, the opposite, where in fact, a lot of what he's been doing, at least with the benefit of hindsight, can be explained by, in this case, 6 simple factors, but really I would argue 2 factors, quality and intangible value, can really capture the vast majority of what he's really been doing.
And Exhibit 18 sort of, I guess, kind of highlights all the points you've been talking about, which shows sort of the factor exposures over the full history of, well, going back to 78, and then more recently in the last 20 years. And you kind of see the shift into more quality and intangible value.
Yeah, and also a shift away from small caps, which is interesting. So what I do in this exhibit, by the way, is I just run the regression a second time, this time on the more narrow, kind of more recent time period. And, the biggest thing you see is that, small caps, were initially insignificant. And then more recently, there's actually a negative loading on small caps, which means that Buffett has favored large caps. And the reason why is pretty obvious, right? Berkshire is now $1 trillion company. There's like not much, small caps don't really move the needle. So he's been kind of forced into bigger and bigger, more liquid stocks. You've also seen an increase in the loading on intangible value by 50%. And this, of course, is consistent with the holdings-based analysis, right? So remember, this analysis here is purely based on historical returns, has no holdings information. It's just what is the return of his portfolio against these factors. But now we're finding that it's pretty consistent with what we saw earlier, where on a holdings basis, the intangible value score of Buffett's portfolio did increase through time.
So this next exhibit 21, you actually looked at the factor exposures, but then you did a sort of sector control to try to get at, maybe removing like financials, for example, that might be like high on the value factor, something like that. So like explain what we're looking at here.
Yeah. So I think, it's worth kind of just spending a second. What is the motivation for doing this? Right. So one of the kind of weird things one of the puzzles that I kind of stumbled upon was this, which is we saw in the holdings-based analysis that Buffett hardly ever buys stocks below book value, right? His only 8% of the time has he bought a stock below book value. And by the way, his portfolio has on average traded at a premium to the actual market, right? So how can that be true? Yet he also has a loading on traditional price to book in his regression-based kind of historical returns. That seems like inconsistent, right? And my hypothesis here was, maybe it has to do with sectors. Maybe it's the case that, Buffett has, he likes to buy, quality high intangible value stocks. But it's also the case that he has a bias towards certain sectors that are in his circle of competence that might tend to be your more old economy sectors. They might tend to be stock sectors that have a kind of correlation with, old school value, right? He doesn't really like tech. He doesn't really like healthcare. He likes, consumer staples and financials. All right, well, we can test that. So all we have to do in our regression is add dummy variables for the various sectors, and we can then rerun the analysis. And what we find is just this, right? So most of the variables stay the same, but importantly, the value factor, the traditional value factor, price to book, the coefficient drops from 0.24 positive to negative 0.06. In other words, it goes from being quite positive to slightly negative, significantly negative, right? And so what that means is that Buffett's apparent favoritism of low price to book stocks is really just an artifact of the sectors he tends to buy. He tends to favor, say, financials, which tend to be cheaper. But importantly, within that sector, the companies he actually buys of all the financial companies are those like Amex, which actually trade at a premium, right? So I think that's like a really interesting, way of kind of explaining why it is, how we can have these two findings that are seemingly contradictory at the same time. By the way, the other thing you find that quality, his quality exposure gets cut in half once adjusted for sector, which is, relevant mainly because we had already said that it's intangible value and quality that kind of collectively drive the bus. Well, once you adjust for sectors, it turns out that really intangible value is the only thing, is kind of the primary driver, and quality less so.
So there is this intangible value, the quality of tomorrow. And this is interesting. So it seems to me like what you're showing here is this, when you can have this high degree of intangible value, and then you sort of show over time how there's increases sort of in profitability, but it happens over sort of like a multi-year period. And this is kind of, and it's like an early indicator of like quality. Am I interpreting that right?
Yeah. So, the reason that this is important is, if you step back, the kind of key insight from this paper is that you can explain Warren Buffett's returns, X's returns at least, using kind of these two key factors, which is quality and intangible value. And, the question then became like, what's the relationship between these two things? Are they complementary? Are they correlated? Like whatever. And, I actually looked at this so I wrote a paper called Intangible Value, the Sixth Factor in May 2023. And that's where this model comes from. And, one of the things I found that was really interesting was that these two factors are basically uncorrelated in statistical terms, like empirically uncorrelated, which kind of seems like a little bit illogical, right? Because, Buffett himself has talked about this idea that economic goodwill or intangible assets are what allow firms to earn excess returns, right? Why is it that a company like, a pharma company or a luxury goods company can charge whatever it wants for what it owns? Well, a patent and a trademark, right? Is the answer. And so why would it not be the case that companies with lots of intangibles should also be the ones that are most profitable? And this is the reason why this chart you showed here, which is there's a kind of intertemporal component where what you can see is that if you make a investment in the R&D today, that there's a bit of a J curve. Next year, it actually may not increase your earnings. It may take many years to pay off. But then in year 2, 3, 4, and then on through time, it'll kind of have an incrementally larger and larger impact on increasing your profitability. So, these sorts of investments in intangible assets are what kind of create future profitability, whereas quality is, strictly measuring historical profitability, which you're making the assumption that this thing won't mean revert, that it'll kind of persist. And so the nice thing about these two things together, so why use quality as a factor and intangible value as a factor together, is because they're complements, that they both are kind of getting at the same thing. One is kind of more backwards looking, one's more forwards looking, but they're both kind of ways of capturing this kind of idea of a moat. And Buffett, again, seems to have kind of landed on that idea organically through his, many years in the markets.
So the next thing you did is you said, okay, so if we know quality is important and intangible value is important, what if I sort of built a portfolio of stocks using those two things? And so what'd you find?
Yeah. So, okay. So here was the idea is we found we said these two factors are kind of can explain most of his returns. Let's actually test that. Now there's one wrinkle, which is that the factors I used for the regressions were long short factors. That kind of inconsistent with like the academic literature and how they do it. But of course, for most practitioners, that's not realistic. So instead I said, let's do something even more simple. Let's build a portfolio of stocks that's just the cheapest stocks on intangible value, and a second portfolio of stocks that the most attractive on trailing profitability quality. So you have a quality portfolio, long only, and a intangible value portfolio, long only. Then what you do is you say, let's build a 50-50 portfolio of these two components. So 50% quality stocks, 50% intangible value stocks.
How many stocks?
In this case, it was a top 20% of the
Okay.
investable universe. I think I did this in the US. So I want to say it would be, 200 or so stocks, 100 to 200
Okay.
stocks.
Yeah.
And then, so yeah, what I found was that the returns of this replication portfolio basically matched that of Berkshire over this period, which is to say they are basically the same over the time period, 78 to today, and, have this 3 percentage points annualized alpha against the S&P.
Sort of the conclusion of the article was you kind of got into sort of Berkshire and Buffett like today. And one of the things that you show is, and I mean, Buffett has been saying this for 20 years, that, don't expect the returns that we've got in the last, however many years are going to be able to be replicated just given their pure size. And this one chart, does show, even though the returns are still very respectable, since since 2008, it's not the type of, relative outperformance that Buffett saw, in the first 25 or 30 years of his history.
Yeah, I mean, I think that's a challenge, right? And as you mentioned, Buffett himself has repeatedly said this to investors as early as the 1980s. In letter after letter, he was predicting, look, like, I know I've crushed the market, but, now that we're getting pretty big, there are a couple things that drags on returns. It's going to be harder to trade, takes longer to get in and out of positions, and the opportunity set is narrowing, right? We just can't buy small caps anymore. That's not even an option. right? So today, you can buy Apple and that's pretty much it. Sorry, that was an exaggeration, but you see my point. And it took many years. I mean, Buffett was like ahead of his time in predicting his own demise. But eventually that the logic of, the math kicked in, and, now at $1 trillion, as you point out, Buffett's still done well in absolute terms, but on a relative basis, he hasn't managed to beat the S&P since 2008. And what's interesting is if you go to the factor decomposition and think of that two-factor model, 50% quality stocks, 50% intangible value stocks. Well, what you can do is you can say, let's look at that more recent period where, Berkshire has failed to beat the S&P. And if you say, what is the decomposition of returns into his factor exposures as opposed to his actual performance relative to factor exposures? It's kind of this tale of two cities. So you see that the factors themselves, quality and intangible value, have continued to outperform over this period, the market. But the problem is that his portfolio itself has underperformed those factors. That negative bit had been exactly enough to offset the positive. So it kind of just neutralizes. But it's kind of masking this kind of bifurcation in terms of, what would the factor model be able to deliver versus what is he actually able to obtain given his now massive size, where you can't really, trade that easily. And, he's kind of sucking a handful of names that are kind of liquid enough for him to hold. Right. And so that's really the big challenge, with where Berkshire is today.
Yeah. And then sort of in closing here, you kind of then ask the question, well, where is Buffett's strike zone? And, if where the focus of that strike zone is, the opportunity set is probably a lot less than it's been historically. Maybe things are a little bit more expensive too in certain areas. And to compound the problem, I mean, I think he has, I don't know, $350 billion in cash on the balance sheet, which, deploying that, that cash balance is bigger than, most of the market cap companies of the S&P 500. So it's kind of crazy how much cash is on hand. But you sort of pointed this out, and then you said, well, where may there be opportunities, beyond the actual strike zone? So I'll let you talk to that.
Yeah. So I think this kind of rising cash balance, right? You mentioned it's what 30% of Berkshire's balance sheet is now sitting in cash, is symptomatic of this challenge that they face today, which is they're getting so big that finding stocks that meet their margin of safety requirements is becoming very challenging. And we talked about this earlier on the conversation, this idea of circle of competence and strike zone, trying to expand it beyond the kind of current. Right? And right now, Berkshire is still pretty constrained. They don't buy small cap stocks. They can't. They don't buy international stocks, right? It's not like a rule, but Buffett has, he's a patriotic guy and basically never put a significant amount of money in a non-US stock. And up until more recently, had a skewed technology too. And the problem is that as Berkshire gets bigger and small caps are kind of more and more off the table, and as technology eats the world, and tech's now 50% of the market, the amount of things that he can invest in has become smaller and smaller. And that's I think what is now manifesting in the kind of this rising cash balance, having a hard time finding things. So the recommendations are twofold, right? Like if we're now saying then the goal, if you are running Berkshire, your goal should be to expand the circle of competence, because if your strike zone's so small, you're just going to be sitting in cash all day. So what do you want to do? There's kind of two dimensions, right? You can't go down this cap range because of their size. So they have two options. One is to get more expertise in technology, which it feels like they're already doing. They already bought Apple. They're starting to sell Apple down now. They made $120 billion on that trade. What if they reinvest that into other tech companies? That would be a reasonable way to go. Tech's a very intangible rich sector. Intangible value works really well in tech. So that would make sense. And then the other thing would be international expansion, right? And one of the nice things about the international markets is that they trade at a pretty significant discount to the US ones on just traditional value metrics, right? So like the on price to Schiller PE, right? International stocks trade about a 50% discount to US stocks. So if you're a long only value investor, right, you're looking for things that are cheap, you want to go to the place where things are still depressed, not to the market, like the US large cap market where Buffett's in, where things have just done really well. And we've seen, Berkshire make strides in this direction, right? They recently built up a 10% position in a bunch of Japanese trading companies. They own BYD. So they're definitely doing some stuff in this area. I would say that if I were them, I would kind of do more. But again, as I mentioned before, it's a battleship. It's hard to really make huge changes, on a dime, especially at their scale. right? So like, I mean, for these Japanese trading companies, they're kind of the max they can be, right? Like at this point. So yeah, I think that's a big challenge. I mean, one of the nice things about the factor replication is it kind of divorces you from these constraints, right? If you're saying, Berkshire is what it is, but like, I can kind of replicate the spirit of the exercise with these two factors. Well, maybe what you can do instead is you can apply these factors not just in, large caps, but in small caps and international areas that, may, for quants, you be indifferent. And, if you're a quant, this factor will work as well in market X as market Y. For a discretionary investor like Buffett and his team, they kind of, know an area really well. They want to stay there, which makes sense, of course. And so one of the nice things about distilling this expertise into these rules, these kind of principles, is that they can be applied more broadly than, Berkshire itself at its scale and given its competencies can do.
So what are the top takeaways, Kai?
Yeah, I think the first thing is that, Warren Buffett was not your grandfather's value investor. People still think of him, link him to Ben Graham, but, long ago, he kind of evolved beyond the teachings of his mentor and incorporated, all these new ideas, transitioning from a kind of traditional value investor to a intangible value and quality investor. I guess the second thing is that, a lot of the principles that he has espoused can be kind of distilled and generalized as quantitative rules, namely, intangible value and quality, which, by the way, are investable, right? You can kind of acquire like investment products or whatever that can go along intangible value or quality, and then can be replicated, as I mentioned, across more market sectors and geographies and size ranges than perhaps Berkshire itself. And I guess the third thing is just that, look, like, I feel like, from a personal standpoint, it's very sad, as I started off, it led with that Buffett's now retiring, right? He's a legend and we all look up to him. And, there's never going to be another Warren Buffett out there. But I mean, the fact that we can, at least generalize his lessons, right? And the principles are not go buy Coke stock. It's go buy, strong brand stocks, right? You can generalize his holdings and positions into these principles, which then can be applied, moving forward. So even after he retires, like his legacy kind of lives on. I feel like that's, a nice finding that will kind of give us investors, comfort as we move forward through time.
It's a great piece, Kai. Thank you very much for coming back on and working through all this with us. Yeah, I really appreciate it, man.
Yeah, of course. Thank you.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.